All right, welcome back to Two Stupid Guys Trade Stocks. I'm Vinny.
I'm Dylan.
Today we're going to talk about a story that I find kind of interesting. Dylan's probably heard me take hints at it before, but I kind of wanted to walk him through a little bit about the full backstory. This is book called When Genius Failed. Talk about leverage a little bit and the kind of implications thereof, and how things that you think are unlikely can kind of blow up your portfolio if you're not positioned correctly.
Got it. Yeah, I've never done that to myself. If you like this kind of entertaining stock market content, where it's two stupid guys who apparently can't say the right word, give us a like and subscribe.
With that, we'll get to it.
Two stupid guys trade stocks.
What do you think of the symbolism here?
There's a track. It reminds me of the Austin Powers scene.
I'm not sure I remember that scene.
There's a guy 50 feet away, and he's driving a steamroller, and he's yelling "stop!" And Austin Powers is going 1 mile an hour slowly to him, and then slowly gets him and kills him.
Oh wow,
that's what I'm thinking.
All right, the analogy I was going for here is picking up pennies in front of a steamroller, but
So that guy then.
Yeah, sure.
That works. That was close.
All right. You remember this? This is kind of the beginning montage of the movie The Big Short, and they're kind of walking you through how we got to where we were as far as the 2008 financial crisis. They mentioned this guy right here. His name is Louis Ranieri. Have you heard that name before?
From you, I believe, but before that, no.
Yeah, I mean, definitely a. As the Big Short says, he's a man you may have never heard of, but he's changed your life in more ways than you would believe.
Perfect. Okay, yeah. So that's not good.
This is the actual man, Louis Ranieri. All right.
Okay.
And he is credited with creating this product called a mortgage-backed security. Have you heard that word before?
I have heard that word before.
Yeah. The kind of intro there from Big Short does a good job of saying, basically in the 1970s, banks were boring. They didn't make any real money. They were just collecting the spread and interest rates, meaning they would make money from, loaning out money and having deposits. That's all it was. They didn't have anything interesting, crazy financial products that were actually profitable. Louis Ranieri and his crew at Salomon Brothers come along and basically create the first real marketable instrument based on mortgage-backed security, right? And they become the dominant financial center for mortgage-backed securities, and also within Salomon Brothers, they're the major kind of maker of money. They're actually making between 80 and 100% of the firm's profits in the 1980s.
Okay.
Yeah. Literally that groundbreaking, right? Now Salomon Brothers, it gets into a little twist here. Have you ever seen this before? You know this guy, right?
I have no idea who Warren Buffett is.
I never heard of him.
No.
Did you ever know that he was chairman and CEO of Salomon Brothers?
Up to this point, I thought you were saying salmon.
Yeah.
Like the fish. So no.
Salmon. No.
I did not.
So they get into a little bit of a grub with the U.S. Treasury. Now, Salomon Brothers was purchasing treasury bonds, and they were only allowed to buy or bid on a certain portion of each auction, right? They could only buy, say, 20%. I don't know the actual number. What Salomon Brothers was doing, as one of their agents, was putting in additional bids as on a client's behalf, right? So that additional bid would exceed, but in reality, the client didn't want it. He was buying extra for the bank. All right.
Okay.
Breaking the rules.
Got
Eventually, this gets found out. I want to say he did it from, it was January to May of 1991. I want to say it was the year.
Now, you're talking about the other guy, not Warren Buffett.
Not Warren Buffett. Warren Buffett is a shareholder of actual Salomon Brothers Investment Bank at that point in time. And the real issue is that they did not disclose this to the SEC when they discovered that one of their traders had gone rogue, right? So this trader, said had gone rogue, and then gets found out, and it gets all the way up to the CEO. This is named John Goodfriend, and they don't report it until I want to say it was September of 1991, right? So they completely discredited the entire kind of upper echelon of management at Salomon Brothers. So bad that John Goodfriend, the CEO, is barred from being a CEO of any investment bank. He's fined over $100,000. Salomon Brothers themselves are fined like $100 million for their actions. And one of the guys is fined $50,000. His name is John Merryweather. Have you heard that name before?
I have not heard that name before.
Well, that's actually who we're going to talk more about here. But Warren Buffett's brought in as the interim CEO to kind of bring a little air of credibility, I guess, back to the investment bank.
Oh, so he picked up the reins after their whole sham?
Yeah. Warren Buffett is like the phone call you make when you've stepped in the actual like shit on Wall Street, basically.
Okay. All right.
He actually comes back at the end of this story again, which is kind of funny.
Yeah, he's a badass.
Salomon Brothers ends up becoming bought out by Travelers Insurance and then Citigroup, in case you're wondering where they end up.
Is that why Citigroup sucks? Okay, sorry.
Maybe. So this is John Merryweather. John Merryweather is the head of the bond arbitrage unit at Salomon Brothers. He's fined $50,000 and basically loses his job as part of this because it was someone that was under him that had executed this treasury kind of fraud. Now, after he leaves, he goes off and starts this hedge fund. Hedge fund's called Long-Term Capital Management. All right, these are some of the partners in this. In addition to John Merryweather, you got Robert Merton. You got a PhD from MIT. He's a Harvard professor. All right. You got Myron Scholes, PhD from University of Chicago, professor at Stanford. Right. David Mullins, PhD from MIT, Harvard professor, former vice chairman of the Federal Reserve.
Oh, that's pretty up there. Okay.
Yeah. We got a couple of guys here, just three more guys with PhDs from MIT. So literally the smartest guys in the room, kind of basically, are the folks that start this hedge fund.
Got it.
All right. Now, their hedge fund is founded on arbitrage. You know what arbitrage is?
Yes. Well, you have the definition right there. So
yeah. Basically, when you're talking about, say, convergence arbitrage, which is the common form of it, you're betting that two prices will come together. Like you and I both, kind of big Alibaba bulls, right? And we talk about how it's traded here in the U.S., it's traded in Hong Kong, it's listed on the DAX, right? In theory, they're all equal, right? They all represent the same underlying entity.
In theory.
So what a company like this would do if they were actually doing securities arbitrage, which is one of the things they do, they would bet on the convergence of those two prices, meaning they would buy the lower priced one and they would sell the shorter priced one. So they eventually, as they come towards like an equilibrium, which is what they should do in theory, then they can capture some profit there.
Got it.
Yeah. One of the companies they do this to is actually Royal Dutch Shell. Not that it particularly matters to this story, but now they are absolutely crushing it. Now you wonder, like, if they're only capturing these tiny little kind of convergence trades, right? How are they crushing, returns like this?
I'm going to go crazy high leverage.
There you go. That's right. Because if your actual return on your capital is very, very small, which they were only getting like 2.4% was their actual return on the capital that they had, whereas the return on equity was these kind of numbers because they were so highly levered. Right? This is net of fees too. This is like blows Kathy Woods out of the water. Okay, let's put it that way.
Yeah. Okay.
I mean, over 40% 2 years in a row. Now, the year that things really kind of take a bad turn for them is 1998. They had some issues in 1997 related to an Asian financial crisis, but they survived that. It was underperforming from their previous couple of years, but they still returned money to partners and stuff like that. They actually said that, because other people saw that they were doing so well, had come into their space and were starting to compete with them, that they could no longer continue investing the same degree of money. So they actually returned money to their investors at the end of 1997. Right? Turned out to be pretty.
They still put up 17%.
Yeah. I mean, 17% is solid. 20% per year, it gets you to Warren Buffett status, right?
Yeah. Very good.
So, beginning of 1998, they have 4.7 billion in equity, 124.5 billion dollars in liabilities, loans. All right, and this is another one this is not on their balance sheet, but derivatives were a thing, right? They blew up in 2008. This is kind of like an early taste of the 2008 financial crisis.
Can you tell me what a derivative is?
So a derivative is a bet on something else. Now, options contracts are considered a derivative, calls and puts.
Okay, got it.
But a derivative option could be anything from like, if say you want to have insurance in case your corn crop doesn't come in, then I can sell you insurance on that. That'd be a derivative. I'm betting on like your corn crop price, say.
Right. Got it.
So they were levered 25 to 1. Yeah.
Oh my gosh.
Yep. So to give you an idea that 25 to 1, you're talking about a 4% or so decrease in the number in the value of things that they owned, the assets that they owned, would basically wipe out all of their equity. Right. That's
Correct.
all it takes.
Yeah, because basically $96 out of every 100 they're borrowing.
Yep. Exactly.
Right. So 4% you're dead.
Yep. So this is the thing that ultimately destroys them. Up until 1998, it was kind of thought that a sovereign government would never default on debt because they don't have to, right? They can just inflate and print money, a la the United States in 2021. Right? Why inflation is running at 6.8% as the most recent month, right? Because it just doesn't make sense. You can just continue running the printing press. But Russia, 1998, on August 17th, decided, nah, we're not going to do that. We're not going to per se run the printing press. We're just going to change the ratios at which we trade to US dollars. They instantly went from this 5.3 to 7.1 rubles to US dollars to 6.0 to 9.5. So they devalued their currency.
Okay.
They said they were going to restructure the debt. They didn't really announce details of that. And then they put a 90-day moratorium on repayment. Yeah.
It's a classic Russia, maybe? I don't know.
Yeah. That's what they call this, I think, the Russian debacle. I don't know.
Yeah, okay.
It's probably actually something called the Russian debacle. So, that happened in August. So they were already starting to bleed pretty heavily. September is really where things explode for them now, because it causes a massive flight to safety. And one of the major trades, the major trade that they made, was looking at U.S. Treasuries. Right, Treasuries are considered a safe haven. Right, U.S. Treasuries. Right. Say, as of still right now, it's kind of the safest investment in the world. Now, what they would do is they would short the current month Treasury auction, and they would buy the next month out. Okay. The theory is that the ones in the most recent month always traded at a higher premium than the ones like 1 month out.
Okay.
Yeah, which is valid by concern. It makes sense that eventually the ones that are printed this month will become next month's, right?
Right. So are you also capturing a bit of volatility at that point too, because you're staggering by a month?
I mean, volatility is important, but they would be. It depends on where you think the flight goes to. Now, it would make sense that, say, if you were looking for safety, the 29.75 year U.S. Treasury bond is probably not any less safe than the 30-year Treasury bond, right? They're
probably not. No.
Safety, volatility-wise, that they should be the same. But in fact, they act very differently in times of extreme stress, and that's exactly what happened. Is that people just didn't fly to safety. They flew to the safest. So they were actually buying up the short, this month, one that they had sold short, and the prices were skyrocketing.
Oh my gosh. Okay. Yep. All right.
So their initial $4.6 billion in equity in that, the beginning of the year had now gone down to $2.3 billion. And now, through the month of September, through a matter of 3 weeks, that $2.3 billion becomes $400 million in equity, meaning they're basically worth nothing at this point.
They're almost broke.
Yeah. The leverage ratio spikes up to 250 to 1.
So now anyone doing the math there, every $1,000 that you're only $4 of those dollars are yours.
Yeah. Yep. Very good.
Bad.
Yeah, very good. That is impressive. That how highly levered they got that quickly. And this is a little chart graph here of the Dow Jones. It's this dip right here that is where this is all going on. The Dow Jones actually sold off 15% over this matter of a few weeks here too, because of the whole Russian default thing. Okay. So aggressive move. Yeah, this is their total performance of their fund.
That looks like a pretty good slide, though, right? Pretty good roller coaster.
A lot of fun. Yeah, I mean, if Six Flags built this, they'd be making money like no tomorrow. All right,
man, that is straight down.
Yeah.
Can you imagine how stressful? What is that? About over the course of probably month and a half, 6 weeks
Yeah,
ish.
it does not
2 months,
take long
7 months.
at all for the two evolve. Unfortunately, that's the danger of leverage. That's the whole point of this thing is that, you know, when you have a levered bet, yeah, sure, you can make money on small transactions or make a lot more money than you really deserve. You know, we actually just shot this $400,000 loss Alibaba stock video, and it kind of relates because option contracts are a levered bet, right?
Yeah.
And that's what happens to these folks here. So ultimately, you know, when the writing was on the wall and they knew that they were going out of business, the first person that they contact is actually Warren Buffett. Again,
Okay.
and he makes an offer to buy them out for 250 million, something that had been worth 4.6 billion earlier that year.
Okay. So he offered 250 million, and
Yeah,
they said no.
yeah, he was 250 million, and all of the managing partners were out. He was
I,
going to take over running the
that's
business.
fair. Yeah.
Yeah,
I mean, look at what they managed. They
I know.
managed it into the ground.
I know exactly. But you know, they still had $100+ billion in actual assets that need to be sold. Never mind the derivatives contracts and stuff like that, which were, you know, complicated one-off instruments that you had to liquidate.
Right.
Um, but yeah, they ended up declining his offer. The Federal Reserve actually puts this other bailout together. They still call it a bailout, even though it didn't include any U.S. Taxpayer money. But the Treasury did kind of organize it, where they brought in 14 banks. They put up a total of $3.5 billion in cash to own 90% of the fund. So, you know, the founders of it ultimately did end up better off. And by my math, they ended up with a 400 something million as opposed to the 250 million that, you know, Buffett had offered, and they were able to stay on to kind of ease the transition of unwinding the fund.
That's so stupid.
Yep. You know
They
what's an
should be
interesting note?
fired. Look at, oh, that's stupid.
Interesting note from here is this: Bear Stearns declined to participate. People have argued that that was one of the reasons why the Fed was so brutal to them in the 2008 financial crisis.
Because they refused to help out here.
Yep. Yeah, that's one of the
Yes.
arguments, because, you know, ultimately Bear Stearns gets sold to Bank of America for like $3 a share, and it was like the Fed that, you know, basically said this is going to happen, and people have argued that that was in part retribution for them declining to participate at this time.
I would have declined to participate too.
Yeah, and
So I
this is really
saw I
what's up.
saw the Salomon. They were one of the banks.
Yeah,
That then is that where Buffy comes back in?
no, he was just the lender of last resort. You know, like I said, if
Oh,
you're at
okay.
Wall Street and you get into trouble and you need money, you know, cash, liquid cash, and you need someone that's going to say like the situation is calm and handled, you bring in Warren Buffett.
I just didn't know if, because you said that he was interim CEO of Salomon for like a short time, if it had been at that time.
No, it
Damn,
was
that would have been
after.
awesome. Because
I
he would have offered like 250 mil. That would have been so cool.
yeah, he was only CEO of Salmon Brothers for I want to say a matter of like months, not very long at all. He just literally, you know, he was on the board and he did this just to kind of help qualm things a little bit until they could find someone that be CEO. Once they axed the John Goodfriend guy because of the whole deal there.
Right.
Have you heard this term before? Moral hazard.
Yes.
Oh yeah, interesting. What do you understand it to imply or mean?
No idea. You said, have I heard it before, Vinny? Not
Okay.
do I know what it means?
No,
No
so
idea.
moral hazard is this concept that people be rewarded for taking upon risk. And that's been the argument that long-term capital management and this ultimate kind of unwinding and bailout only helped precipitate the 2008 financial crisis by ensuring that there was this moral hazard, as in like the people that took this ridiculous level of risk, leveraging 25 to 1 and betting on things that were far more correlated than they realized, you know, were bailed out ultimately at the end of the day by these banks.
Okay.
Now,
Yeah.
so that's the argument, is that the banks were emboldened to continue to be aggressive and to, you know, reward this risk amongst their kind of, you know, traders. There was actually a
I
term
don't
that
like
was coined back in the Salomon Brothers days, where they refer to themselves as big swinging dicks of Wall Street, in case you never heard that before.
that. How much of an ego can you have?
Yeah, I know, right? That's literally
Jeez.
where it's coming from with, you know, that takes us all the way back to the Louis Ranieri days. Like, you know, those guys are like, they talk about the Liar's Poker is actually a really good book about that. I forgot I brought these things out. Just Liar's Poker. This is the book about like the Louis Ranieri days. Michael Lewis, right? Moneyball. You recognize the
Yeah.
name? Yeah. So he was
Oh
actually.
man, I didn't put that together. Yeah, the guy from Moneyball did that.
Yeah, so he wrote this book in 1989. This was like his big breakout book, and he was a bond trader at Salomon Brothers back in those days. That's what this is like about.
I didn't know that at all.
Yeah.
That's wild.
So then this other book, this is Roger Lowenstein, who's actually like a Wall Street historian. When Genius Failed, that's the book about long-term capital management and their kind of rise and downfall. Both of them well worth reading, in my opinion. I enjoyed them thoroughly.
Man, solid. Okay.
But yeah.
That was interesting. I didn't know the intimate details of that.
Yeah, I figured you find it interesting.
You told me like the little bit, like in school, like 4 years ago. And I was like, man, they were way too levered. I didn't know all the details.
Yeah, exactly. I think it's a cool story, and it's always good to kind of look back at the Wall Street history so you can have a little bit better understanding of how we got to where we were. And like the moral hazard concept is definitely important, and we're still seeing, I would say, fruits of that to this day, where you saw this Archegos Capital kind of blow up there. You're seeing right now the Evergrande crisis out of China. There's just this safety net for these large corporations, this too big to fail concept. And
yeah, it's really messed up.
Yeah,
I don't like it at all.
It's almost like or the Wall Street Bets guys love this line. I don't know if you've heard this one. If you how do they put it? If I owe $5,000, that's my problem. If I owe $5 million, that's my bank's problem.
Oh, that's pretty funny. I like that. That should be a bumper sticker.
Yeah, that's literally moral hazard on an individual basis, because you're like, whatever.
Yeah, it's fair. That works.
All right, guys. So let us know what you think, guys. Just curious if you guys enjoyed this kind of like historical Wall Street storytelling kind of stuff, and if you enjoy it, let us know. We'd love to hear back from you.
Yeah, Vinny's got a bunch of these. All right. Thanks, guys.
Catch you on the next one.